We are often told that the revolution in finance is happening in our pockets. We look at the sleek glass of our smartphones, the vibrant greens and reds of trading apps, and the convenience of a tap-to-pay interface, and we assume that this is the pinnacle of financial technology. But for those of us who have watched markets move over decades, we know that the interface is rarely where the real story lives. The app is a distraction, a polished veneer over an ancient machine. To understand the future of your capital, we have to look past the pixels. We have to look at the plumbing. The real transformation isn't about how you interact with your money. It's about how money itself has been redesigned at the atomic level. This is the invisible architecture of global wealth. If you want to know if a building will stand for a century, you don't look at the paint in the lobby. You look at the foundation. For the last 50 years, the foundation of global finance was a mess of manual ledgers, physical certificates, and human intermediaries. Today, that foundation is being ripped out and replaced with real-time, automated infrastructure. This isn't just disruption, a word that has lost its meaning through overuse. This is a fundamental restructuring of the global ledger. In this deep dive, we are moving into the basement of the global economy to examine the structural evolution that will define the next 40 years of wealth preservation. To appreciate where we are going, we must remember where we started. For the man who began his career in the 80s or 90s, the concept of friction was tangible. Finance was a physical industry. When you bought a stock, there was a literal piece of paper, a stock certificate that represented your ownership. The movement of money was tied to the movement of paper. This created what we call the T+2 or even T+5 settlement era. It wasn't just a regulatory choice. It was a physical necessity. It took days for the world to catch up to a single decision you made at a desk. This lag was the defining characteristic of 20th century finance, a world of manual bottlenecks where trust was verified by stamps and signatures. Many forget that in the late 1960s, the New York Stock Exchange actually had to close on Wednesdays because the plumbing had backed up so severely. They literally could not process the paper fast enough. This paperwork crisis was the first sign that the old way of doing things, relying on human speed to verify wealth, was unsustainable. The solution back then was early digitization, but the core philosophy remained the same: batch processing. Everything happened in clumps, at the end of the day, behind closed doors. We lived in a world of delays, and those delays carried hidden costs, liquidity risks that we simply accepted as the price of doing business. The first major shift in our modern era is what I call the APIfication of money. In the past, a bank was a fortress. If you wanted to use their services, you had to enter the fortress on their terms. But over the last decade, banking services have been unbundled. They have been turned into modular pieces of code, application programming interfaces, or APIs. Think of it like Lego blocks. A company no longer needs to build a bank to offer banking services. They simply plug into a payments module or a ledger module provided by someone else. This is how money became embedded. It is why your accounting software can now talk directly to your brokerage, and why your business can issue credit cards without ever visiting a branch. Money is no longer a destination. It is a feature of the software we already use. This unbundling is a double-edged sword for the long-term investor. On one hand, it has stripped away the friction that used to eat our returns. The cost of moving capital has plummeted because the human middleman has been replaced by an API call. On the other hand, it has made the financial system more interconnected and complex than ever before. When money is code, it moves at the speed of light. The moat that traditional banks once enjoyed, their physical presence and exclusive access to the ledger, has evaporated. We are moving into an era where the most valuable financial institutions are not those with the most branches, but those with the most robust and reliable code. For decades, the world's largest banks ran on on-premise mainframes, massive, isolated computers stored in their own basements, running code written in the 1970s. This was seen as the gold standard for security. If the computer isn't connected to the outside world, it can't be hacked. But this isolation also made them rigid. They couldn't scale and they couldn't innovate. We are now witnessing the great cloud migration. The systemic institutions that hold your retirement accounts and manage global trade are moving their core ledgers to the cloud, to AWS, Azure, and Google Cloud. This is a massive shift in the risk profile of the entire financial system. While the cloud offers incredible resilience against local disasters, it creates a new kind of systemic risk: concentration. In the old world, if one bank's mainframe failed, only that bank was affected. In the new world, if a single cloud region goes dark, the entire global payment system could stumble. For the sober investor, this requires a change in perspective. We must stop asking, "Is my bank safe?" and start asking, "Is the infrastructure my bank relies on resilient?" The move to the cloud has made finance more efficient, but it has also created a single point of failure that we are only beginning to understand. We have traded the friction of the past for the systemic complexity of the future. As we conclude this first look at the invisible architecture, I want you to consider your own position. You have spent decades building capital in a system that was defined by physical limits and human oversight. That system is being replaced by a digital organism that never sleeps and moves at a scale human minds struggle to grasp. This is not cause for alarm, but it is cause for deep, analytical reflection. The horizon isn't just a point in the distance. It's a way of looking at the ground beneath your feet. In our next section, we will look at how this shift from human trust to algorithmic trust is fundamentally changing the way we value our assets. For decades, the bedrock of finance wasn't a ledger or a vault. It was a relationship. If you are over 40, you likely remember a time when credit was as much about a conversation with a branch manager as it was about a FICO score. That era of human-centric trust is being methodically dismantled. We are moving toward what technologists call zero-trust architecture. In the legacy world, trust was a centralized asset held by institutions. You trusted the bank because the building looked permanent and the manager lived in your zip code. Today, trust is being fragmented and codified into mathematics. When we speak of decentralized protocols or smart contracts, the revolution isn't the currency itself, it's the removal of the human intermediary. We are replacing the fallible, biased, but ultimately empathetic bank manager with an immutable, cold, but perfectly consistent algorithm. This fragmentation means that trust is no longer something you give to an institution. It is a technical requirement built into the very packets of data moving across the wire. For the long-term investor, this is a double-edged sword. It removes the risk of human corruption and local mismanagement, but it also removes the slack in the system. The ability for a human to look at your unique situation and say, I know this man, let's make it work. In the new architecture, if you don't fit the code, you don't exist. In our pursuit of the frictionless economy, we have made a dangerous assumption. That speed is always a virtue. In the T+2 era, where it took 2 days for a trade to settle, there was a natural buffer built into the global markets. This friction acted as a physical circuit breaker. Today, we are pushing toward T0, real-time settlement. On the surface, this is an engineering triumph. It frees up billions in collateral that used to sit idle. But we must ask ourselves, what happens to a system when you remove all the dampers? This is the efficiency trap. By optimizing for speed, we have increased systemic fragility. When liquidity can move in a millisecond, it can also vanish in a millisecond. We saw this in the flash crashes of the last decade, and we see it in the way modern bank runs happen via smartphone apps in hours rather than weeks. For the man focused on the horizon, this means the market you participate in is fundamentally more volatile than the one your father navigated. It is a high-frequency environment that demands a low-frequency mindset. If the plumbing is built for light speed, your strategy must be built for decades to avoid being caught in the turbulent wake of automated liquidation engines. The greatest challenge for the modern investor is distinguishing between feature fintech and foundational fintech. Most of what you see advertised, the sleek trading apps, the colorful spending trackers, the buy now pay later buttons, is feature fintech. These are decorative layers. They are the paint on the house, not the foundation. They are designed for engagement, not necessarily for wealth preservation. They are often disposable and highly susceptible to the hype cycle. Foundational fintech, however, is the invisible architecture. It is the migration of legacy ledgers to cloud-native, distributed systems. It is the implementation of ISO 20022 standards that allow banks to talk to each other in a common language. It is the shift from batch processing, where the world's books were balanced once a night, to streaming finance. As an analytical observer, you should care far less about which app has the best user interface and far more about which institutions are rebuilding their core plumbing. Foundational shifts are evergreen. They change the cost of capital and the nature of ownership for the next 50 years. The noise of the interface is a distraction from the signal of the infrastructure. If you want to understand where the world is going, look at the pipes, not the faucets. We must move past the idea that a bank is a place. In the digital era, a bank is no longer a building on a street corner or even an icon on your phone. A bank is a process. It is a continuous, real-time flow of data and value. For the man over 40, this realization should be liberating rather than daunting. You are no longer tethered to the geographic or institutional limitations of the past. However, this new world requires a higher level of intellectual honesty. You cannot outsource your understanding of the plumbing to a local manager who likely understands it less than you do. You must recognize that in an era of automated trust and high-speed fragility, the ultimate hedge is time and sobriety. The technology has rebuilt the ground beneath our feet, but the principles of capital preservation haven't changed. Understand what you own, understand how it is settled, and understand the risks of the system itself. This is the quiet revolution. It doesn't happen with a bang or a market crash. It happens in the steady, silent replacement of the old world's wires with the new world's code. Your portfolio is no longer just a collection of assets. It is a participant in a global digital engine. Respect the engine, but never forget that you are the one deciding where it's headed. The architecture is invisible, but the impact is absolute. As the noise of the day-to-day market fades, look to the horizon. That is where the real structural change is visible. We'll continue to watch the plumbing so you can focus on the path. Thank you for your time.